Welcome back. Like we've been telling you, markets across Asia are giving mixed signals today. The Japanese market is shut, but there's some green across the Hang Seng, even mainland China for that matter. So mixed picture. Let's pull up the implied open. I mean, we've been grinding low for the past 4 weeks now, almost coming down to a 1-month low on the Nifty. And that implied open is not offering too much of comfort. Let's see, maybe the real opening manages to defy that because the earnings have not been too bad. So let's get to the good news, actually. Starting off with the CNBC-TV18 list of top stocks to watch. And our team is standing by with all the top stocks that we need to look at. Guys, good morning to all of you. Let's start first with Reliance Industries. Sonal, how does the consolidated picture look?
Inline set of numbers this time. If we look at the EBITDA number, it came in higher on a YOY basis at 42,900 crore rupees. Margins higher at 17.6%. Profits, quarterly record that we saw this time, around 26,994 crore rupees. This was aided by higher other income, which was aided by that stake sale in Asian Paints by the company. That was around 8,900 crore rupees. This time around, the company saw double-digit growth in Reliance Retail. In terms of the Jio business, revenue growth was driven by both the subscriber growth and ARPU growth as well. O2C EBITDA margins came in higher, though there was an impact of a maintenance shutdown that the company took, but the outlook is positive going forward. Mukesh Ambani reiterated their plan of doubling the business every 4 to 5 years. So that was an important statement that came by. In terms of brokerage commentary, Morgan Stanley has an overweight rating with a target of 16-17 on the stock. Jefferies is projecting 11% EBITDA growth over FY26. They also maintain a buy with target price of 17.26. And Motilal Oswal, they've gone ahead and increased the target price on the stock to 1700 versus 1685 earlier.
Okay, all right. Thanks a lot for that, Sonal. Well, let's hop across to Gaurav. He's here to tell us about the other big boy, HDFC Bank. Morning, Gaurav.
Well, yes, a good set of numbers from HDFC Bank in this quarter because net interest income increased almost by 11%. We saw 11% growth on pre-provisional operating profit and PAT increased almost by 12%. That was actually higher than what the street was expecting. Now, there was a one-off impact in this quarter because of the HDB sale worth 9,000 crores. But what bank did is that they actually created a floating provision worth 9,000 crores. So definitely net off, there was no impact on the profitability because of that. In fact, they also created a contingency provision of 1,700 crores. And if we exclude that, the provisions were also in line with what the street is expecting. What was positive is that the credit cost actually in line as a result in the range of around 0.54%. And at the same time, the net interest margins, they declined a little bit, almost by 19 basis point, but core net interest margins declined just by 11 basis points as per brokerages. As a result, we saw some upgrades from brokerages as well. We've got Nuvama, Investec actually giving their bullish call. We also have some other updates. Company has declared the dividend, special dividend of 5 rupees per share, and they have also declared bonus issue. So that is also something that we will be watching out for. And as a result, definitely a positive reaction is what we are expecting in HDFC Bank today.
Gaurav, morning. What about ICICI Bank?
Well, a good set of number here as well. ICICI Bank did not actually disappoint in beating the street's expectations. When we look at net interest income, that increased almost by 11 basis point. Profitability increased almost by 15 basis point. When it comes to operating profit, there also we saw a good set of number, around 17% of increase on a year-on-year basis. What was actually positive is that the net interest margins declined just by 7 basis point versus the expectation of 18 to 19 basis point decline. In fact, there were some changes in the accounting policy. And as a result, management also indicated that if we compare on a like-for-like basis, the net interest margins have declined only by 4 to 6 basis points. So that was actually a very big positive. In terms of loan book and deposits, there also we saw a good set of numbers, 12% growth in terms of loan book and 13% in terms of deposits. Actually, when we talk about the cost of funds, now management has indicated that cost of fund will go down in Q2 FY26. There will be some kind of pressure in net interest margins in the coming quarter, but definitely management remains sound in terms of the optimism coming up from the bank, and that is the reason this bank is also in our list today on the back of the good set of numbers and good commentary also coming up from the management.
Okay, all right. Thanks a lot for that, Gaurav. Busy weekend for you. But let's focus on JSW Steel then. Those numbers look quite good. That's why I'm going with green. And as I mentioned earlier, Chinese commentary could keep some of these metal stocks quite interested today for the bull. Now, the reported EBITDA, well, that was a little bit better than what we were working with. The standalone EBITDA per ton, yes, there was an improvement. One would say they wanted a bigger improvement out there, but 10,600 rupees per ton is good. The bigger beat, though, came in from their other India operations. That is the coated steel products out there. There was a good bounce in the EBITDA. Even Bhushan Power and Steel, well, out there as well. Solid bounce out there. So both those two really made up for any kind of miss if in case you're looking at the standalone EBITDA per ton and, saying that it's not good enough. So the India operations on the whole look solid. US operations very good out there as well because you had improvement in profitability. For the quarter, they delivered $20 million of EBITDA, which is encouraging. Net debt number moved up a little bit, but that's par for the course because the net debt to EBITDA is still under check. In fact, that came in lower. The con call takeaways as well were quite encouraging because quarter two volumes actually will be higher, which will make up for some kind of softness that we're likely to see in the seasonally weak quarter because of the monsoon. So going with green on JSW Steel. And we'll have a chat with Mr. Acharya at around 9:40 a.m. later today. Hopping across to Ritu. She's here to give us some scoop on Axis Bank. Ritu, tell us more.
Well, the surprising spike in bad loans which dented Axis Bank's profitability in the recently announced first quarter numbers that the bank attributed to a technical impact was actually not entirely a proactive move by them. We've been given to understand that this followed a regulatory intervention from the Reserve Bank of India, which had raised some red flags about Axis Bank's asset classification practices during a supervisory review in the January-March quarter of this year. Now, RBI found that the bank's NPA recognition policy was too lenient. While the bank was compliant with RBI's income recognition and asset classification norms on paper, we understand the regulator felt that the bank's internal policies were not aligned with the spirit of the regulation, and in some cases, this was leading to a delay in recognition of stress or even under recognition of stress in some cases. Particularly, this was seen in the unsecured retail and small business loan segments. So, in response to this nudge from the RBI, Axis Bank revised its internal framework, which then led to that 614 crore rupee hit to the bottom line, the additional 2,709 crores in gross slippages, and 821 crores in provisions because of the so-called technical impact. Now, on its part, the bank called the move a prudent application of enhanced qualitative criteria, which was aimed at making the balance sheet more resilient. Importantly, though Axis Bank's NPA recognition framework was seen as falling short of regulatory expectations, our sources have made it amply clear that they should not be compared with the IndusInd Bank case, where major accounting lapses have come to light. In Axis Bank's case, the issue was about policy interpretation, not financial misreporting.
All right, Ritu, thanks very much. And that explains, that was a big question that was unanswered till now, that why suddenly now? Why change your NPA recognition policy now, which led to that huge rise in slippages? And Ritu confirming with her sources that this seems to be a nudge from the Reserve Bank of India. Very important story there, Ritu. Thanks very much for that. But let's get back to Nigel. Nigel, JK Cement looking good?
Well, the stock is near a 52-week high and valuations are not cheap. And they justify that. Numbers look very, very good. Top line, there was a growth of close to around 19%. The EBITDA number went up by more than 40%, indicating there was margin expansion. And when you grow by 19% on the top line and you have your power and fuel costs going up by only around 7%, telling you that operating leverage is playing out. And also the focus on cost is definitely playing out there. Profit number as well jumped up by more than 75%. What worked for them? Sequential basis, realizations were up only around 1%. But if you're looking at the volume front, the grey cement volumes was up 16%. And that's where the big beat came in because the operating leverage played out. And the EBITDA per ton on a year-on-year basis, it improved from sub 1,000 rupees to more than 1,200 rupees per ton. On a sequential basis, there was a bit of a dip, but that's par for the course. So short point being, these numbers look good. Operating leverage playing out there. They've gained market share in their core markets as well in Bihar and other central region markets. And also their debt pretty much intact. They're on their way to be a 30 million ton plant. So going with the bright green on JK Cement. Remember, the stock though is at a 52-week high. Gaurav, coming back to you though. AU Small Finance Bank and Bandhan Bank, how are the numbers?
Well, when it comes to AU Small Finance Bank, the beat was there in terms of profitability, increased almost by 15%, which was actually higher than the street's expectation, but that was specifically led by the treasury gains. Now, what remains as a key concern is that now bank has increased their credit cost guidance somewhere in the range of 1%, which was earlier in the range of 0.85%. 8%. So what they are saying is that there will be some kind of pressure in second quarter as well because of the stress in MFI. They are not seeing the stress in MFI easing specifically because of the collection issues. On the other hand, there was another issue as well, which is net interest margins that declined almost by 40 basis points on a sequential basis, where Street was expecting around 30 basis point of fall. So definitely a little bit of negative sentimental reaction is what we can see, given that there was an outperformance for the stock for the last few days. Another news is that that is on the Bandhan Bank. Now, here again, the numbers are actually fairly in line, or rather better than what the street is expecting. NIM decline was somewhere around 30 basis point, again with what the street was expecting. What was concerning is that the write-off factor. Now, in this quarter, slippages, although they have come down, the write-off is specifically from their emerging enterprise business segment. So let's look at the numbers. There was a write-off around 1,047 crores in this quarter, out of which EEB contributed to around 952 crores. So that is something which is concerning because a huge chunk of EEB is going in the write-off, and that is something that we will be also watching out for Bandhan Bank.
Okay, all right, Gaurav, lots of financials, so busy weekend and busy day for you ahead as well. The management will come up at 10:15 in conversation to talk about numbers and the outlook forward. Well, Sona BLW is the next one we focus on. This is a CNBC-TV18 exclusive, and Vivek had reported, along with Parikshit from Delhi, that the deal was happening, and the announcement has come through now. Vivek, what are the details?
Well, that's right. On July 17th, CNBC-TV18 had reported that Sona BLW was most likely going to go ahead and onboard one of China's largest EV companies, BYD, and it also told you that the company was likely to set up a manufacturing plant in China to support the OEM story over there. Along those expectations, in line with what we had reported yesterday, Sona BLW informed the exchanges that the company had formed a JV with a Chinese company, JNT. Now, Sona will be going ahead and investing close to $12 million in this particular JV to take a 60% stake. JNT will contribute the remaining $8 million. Now, along with that, what is the company saying? The company is saying that the JV is expected to commence operations in H2 FY26. The JV will manufacture and supply driveline systems as well as components, indicating that the order is already in land. Whole host of brokerages have reacted to this particular material development as far as Sona is concerned. Elara says there's a significant positive in terms of supporting valuations for Sona. Investec says that the JV with JNT will provide exposure to the largest EV market and will help tap Chinese OEMs. JV with JNT will help reduce customer risk. ICICI Securities says that the stock has underperformed the overall auto universe, and they believe that from this point on, the stock has bottomed out and should start outperforming from here on. And JM Financial says that this particular JV represents a substantial growth opportunity. And JM also goes ahead and names the likely anchor customer, which is BYD. It's important to note that Sona generally does not go ahead and call out the name of their client. Even in the case of Tesla, they do not call it. And even in this particular case, they have refrained from naming BYD as a client.
Okay, all right. Got it. Thanks for that, and congratulations on that news break, Vivek. Well, with that, let's quickly move on. Jio Finance announced a tie-up. They're getting into the insurance space. Vamakshi is here with the details. Morning, Vamakshi.
Good morning, Subhi. Well, going with the green for this counter because the company has announced a 50-50 JV agreement with the Allianz Group for the domestic reinsurance business here in India. Keep in mind, this comes after 4 months wherein, the Allianz Group had exited its 2-decade-long partnership with the Bajaj Group. The JV operations will be launched only after statutory as well as regulatory approvals will be in place, and will leverage Allianz's existing Allianz RE as well as Allianz's commercial portfolio and activities in India, and will also benefit from the global setup that Allianz Group brings with them. Now, in addition to this, what they've also done is entered into a non-binding agreement with the group for setting up equally owned JVs for general as well as life insurance businesses here in India. So therefore, the agreement for reinsurance as well as a non-binding agreement for general and life insurance bodes well for the company.
Got it. All right. Thanks a lot for that, Vama. Well, let's